Every investor needs to think about how their portfolio will do if inflation doesn't come back down to 2%. The reasons start with the federal deficit. Our debt to GDP is back where it was at the end of World War II, only this time there's no prospect of it coming back down, and the Congressional Budget Office revised its path a good bit higher just in the past year. Debasing the currency is a time-tested way for governments to handle excessive debt. We're starting to do that in this country. Quantitative easing has become a permanent and partial monetization of debt. Ever since the great financial crisis in 2008, the Fed has found reasons to keep growing its balance sheet. Other central banks like to own our bonds too. Growing debt means more interest expense. In 5 years, the interest expense alone is going to cost us $1 trillion a year. That's 2 years ahead of what the CBO was forecasting just last year. It's because interest rates have gone up. The Fed's belated fight against inflation is making our fiscal situation worse. This means they have less ability to raise rates than if we had more manageable debt. Add to that the banking system, which has seen unrealized losses on its bond portfolios grow to $620 billion in just the past year. Part of the problem is that quantitative easing kept rates low for a long time. During this time, US banks extended out on the yield curve. They added interest rate risk when rates were low. This is why last year they suffered a bigger loss in Tier 1 equity capital than at the start of the pandemic, when banks sharply increased their loan loss reserves. Fed tightening is creating competition for cheap deposits that banks need to fund their underwater bond portfolios. The path of least resistance is to live with a little higher inflation. Not 6%, but 3% or 4% will look like a decent compromise. It'll help the federal government manage our enormous debt, and it'll give banks time to let their low-yielding bonds mature. We believe that midstream energy infrastructure offers protection. These long-lived assets are vital to America's energy security. We're exporting more oil and gas to our friends and allies around the world, and analysts estimate that half the EBITDA generated by the industry is from contracts that reprice with PPI or CPI. Think about what a few years of 3 to 4% inflation will do to your retirement portfolio. We think you'll find energy infrastructure should be part of the solution. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.